In 2017, Germany built 5.65 million cars. By 2021, that had collapsed to just over 3 million, its lowest level in decades. More than 2 million fewer cars a year from peak to trough. And here is the part nobody tells you. It never fully came back. Today, Germany still builds around 4.1 million cars, better than the trough, but still about 27% below that 2017 peak. A quick honesty note, because the internet got this one wrong. You may have seen a viral figure floating around for German car production in 2026, and it is simply incorrect. The carmakers' own association forecasts about 4.1 million cars for 2026, essentially flat. So the real story was never a single bad year. It is a structural reset, and you are about to see exactly what broke. So here is the reframe this whole video rests on, and it lands in one sentence. For 20 years, Germany got rich on two things: cheap Russian gas and an export machine that sold cars and machinery to China. Those two pillars were not a weakness, they were the genius of the German model. Then, within the same short window, both snapped. The gas got cut off, and China stopped being the customer and started being the competitor. The very strengths that built the economy became the precise mechanisms now hollowing out its industry. Economists have a colder word for that than recession. They call it structural deindustrialization. The damage does not simply bounce back when the business cycle turns. That is the open question we are going to test against the numbers. And this is not abstract. It shows up in real jobs, in real towns. Volkswagen, the symbol of German industry, agreed in December 2024 to cut up to 35,000 German jobs by 2030 through retirements and voluntary measures with no compulsory layoffs. Instead of closures, it is pulling roughly 700,000 units of annual capacity out of the country, about one entire flagship plant's worth of output. If Wolfsburg is not safe, nothing is. Bosch, the world's largest auto parts supplier, announced 13,000 more German job cuts, also by 2030. Almost all of it is concentrated in the country's industrial southwest. These are not startups failing. These are the crown jewels of German engineering, cutting at the core. The question is why? And the answer starts with energy. Pillar 1 was cheap energy. Germany imports roughly 95% of the gas it burns. For decades, it solved that with one elegant answer: buy it cheap from Russia. Right before Russia's 2022 invasion of Ukraine, Russia supplied roughly 55% of Germany's natural gas imports, with Norway around 30% and the Netherlands around 13%. Cheap, abundant energy was the hidden subsidy under every furnace, every chemical reactor, every steel mill, and, it turned out, a single point of failure. After the invasion, that share collapsed from 52% in 2021 to 22% in 2022. Nord Stream 1's flow fell from about 1.7 terawatt-hours a day to zero in under 3 months. The first pillar did not wobble, it was cut. Now watch what that did to the price of running a factory. Industrial electricity for a mid-sized German plant went from around 13 cents a kilowatt-hour to a peak near 20, roughly a 50% jump. And here is the part that turns a crisis into a structural problem. The prices never really came back down. By late 2025, German industrial electricity was still above the 2022 crisis peak and nearly triple what it was in 2017. So where does that cost land? On the most energy-hungry industries. Output in Germany's energy-intensive branches was down nearly 18% in 2025 versus 2021. The chemical industry ran its plants at only about 70% capacity, the weakest in 20 years. And the steel market has lost about a third of its volume since 2017. a third, gone.
That is pillar 1.
Now the second arc, and this one is stranger because it did not break. It reversed. For 2 decades, China was the dream customer. 1 billion people buying German cars and German machines. German exports to China peaked at about 107 billion euros in 2022. Then they fell, every single year, to just over 81 billion by 2025, about 23% below the peak. But the export number hides the real shift, the reversal of direction. In 2025, German exports to China fell almost 10%, while imports from China rose almost 9%. And the single biggest driver is the same industry from our cold open: cars. German car exports to China fell roughly 66% between 2022 and 2025, according to Rhodium. The dream customer became the toughest competitor by learning to build the very thing Germany used to sell it. Now here is the part most "Germany is finished" videos skip, because it complicates the story, and the truth should. This is not a free fall. German car output recovered off the trough and has been roughly flat, near 4 million for 3 years. The economy did contract 2 years running, but edged back to barely positive growth in 2025. So there is a genuine debate here: cyclical or structural? Forecasters land cautiously positive. The Bundesbank, the European Commission, and the IMF all see weak but positive growth in 2026. Germany still holds enormous strengths: engineering depth, brand trust, €500 billion it can now spend. So the honest read is some of both. But the structural signals are hard to wave away. Manufacturing production is running roughly 13% below its pre-pandemic level, and the wound sits in exactly the sectors the 2 pillars used to protect. And then Germany did something it had not done in modern memory. The country, whose entire identity was fiscal discipline, broke its own most sacred rule. In March 2025, it amended its constitution to create a €500 billion special fund for infrastructure and climate, and to exempt defense spending from its debt brake, the limit it had written into the basic law back in 2009. Changing it needed a 2/3 majority. The fund splits $300 billion to the Federation, $100 billion to the states, and $100 billion to climate. That is the confession. The country that lectured Europe on living within its means decided the moment was serious enough to borrow at historic scale.
So step back.
Why does this matter beyond Germany? Because Germany is the engine of the European economy, and that engine is now spending its way through the transition. The borrowing has a cost. The deficit was 2.7% of output in 2025. The European Commission projects it widening to 3.7% in 2026 and 4.1% in 2027. Public debt is forecast to climb towards 68% of output by then. That is the trap in one line. The 2 strengths that made spending unnecessary for 20 years are exactly why Germany must now spend at record scale. Cheap energy is gone, and prices are still rising. The export customer turned competitor and is selling back into Germany's home market. Which brings us back to where we started: those cars. 5.65 million in 2017, just over 3 million at the bottom, about 4.1 million today, and forecast to stay flat. The line did not crash to zero, and it did not bounce back. It reset to a lower normal. And that is what structural change actually looks like. Not a headline, but a level that quietly stops climbing. Nobody made a single catastrophic mistake. Germany leaned its whole weight on 2 strengths and discovered at the worst possible moment that a strength you cannot replace is just a dependency wearing a nicer name. The strengths became the trap. The only open question now is whether 500 billion euros can build a third pillar before the first two are fully gone. If you want the economics behind the headlines, not the panic, subscribe. We do this every week.